This is chapter 22, where we're going to talk about responsibility accounting and transfer pricing. So let's go ahead and get started. We start by talking about Cisco systems. Cisco makes routers, and they use responsibility center accounting methods that we describe in this chapter. Just like you are responsible for how you do in this class and in life, I guess, businesses hold employees accountable. So let's see what they say. It says we conduct business globally. Our management makes decisions and allocates resources based on the information they get from the internal management system. Sales are attributed to segment based on the ordering location of the customer. They do not allocate research and development, sales and marketing, or general administrative expenses because management does not include the information in our management of the performance of the operating segment. So what it's saying is, hey, we make our managers responsible for what they're responsible for. And they're not responsible for overall corporate numbers, but they are responsible for those charges in their segment. So although Cisco could have chosen product and service lines such as network platform, software, and technical support, they chose geographic segments for their responsibility. So we're going to talk about how that works here. So responsibility centers are a number of different subunits. Production departments, sales departments are often further subdivided along different product lines or geographic areas. So that's what we just talked about for Cisco. They do it along geographical areas rather than along product lines. Organizing a business in this manner allows managers and employees to specialize in certain types of business activity and establishes clear lines of management responsibility. Okay, so let's see how this goes. Companies use many different names for how they divide up a business. It might be divisions, departments, branches, sales territories, product lines, but we're going to use the term responsibility center to talk about a subunit, and we're going to talk about the designated manager who is in charge, who is responsible. Okay, so what are they responsible for? They're responsible for planning and allocating resources. They're going to put it in the areas of greatest profit responsibility. They're going to use the ones where they have control, so they can identify portions of the business that are not efficient, and they can work and emphasize those areas. And then we are going to use an evaluation of the performance of these center managers based on what they're responsible for. So let's talk for a minute about Newtek. Newtek is the example we're going to use here. They operate online sales and several retail stores in Chicago area. So although responsibility is delegated down an organization, accounting flows up through the organization. So let's see what the hierarchy looks like here. And you can see, hey, there's a board of directors, there's top management, there's the two divisions we just talked about. These are the investment centers. The retail sales division has those retail stores. They have all of the various responsible elements to these. They have profit centers and they have cost centers. So accounting, hey, let's minimize the cost. Janitorial, let's minimize the cost. But sales department and repairs department, we want those to be profit centers. So you see within these various groups, there are investment centers, profit centers, and cost centers. And notice how accounting flows up and responsibility flows down. Okay, so that's kind of the setup here. A cost center is a business segment that incurs costs but that does not directly generate revenue. So the example on this last page was for Newtek is accounting and finance and maintenance and janitorial, but also data processing and legal services. Okay, so they can't directly affect profits or revenues, but they do incur costs. And so they are responsible for the cost, but not for selling the products. Cost centers are evaluated on their ability to control costs and the quantity and quality of their services. That's what they're responsible for. Okay, so they're going to be regarded as a cost center. How about profit centers? Well, profit centers are going to be responsible for the profits, so both the revenues and the expenses. So within this organization, it's the retail stores. and that includes the sales and repairs department, are all viewed as profit centers. So if we go back here, we'll notice here's the profit centers, the sales department and the repair department. So we can see what those look like there. Okay, so let's switch back and go and we say, hey, they are responsible for revenues. They're not responsible for major capital acquisitions. That's going to be when we talk later about an investment center. But they are responsible for profit centers and will be evaluated primarily on how profitable they are. The third type, investment centers. So the investment center here is a profit center for which management is given decision-making responsibility. So not just the profits, which means not just the revenues and the costs, but also the investments made, typically capital investments that are made. And so the investment center manager will have the ability to make capital investment decisions. Capital investment decisions are usually large, like a factory, a store, a huge piece of equipment, a truck. They're going to be responsible, investment centers will be responsible for those. So let's assume that we're part of the online or a manager for the online sales division of NewTek. They assume that you are the manager of the sales department. To meet the profit goals and expectation of the division head, you've been promising customers that orders will be expedited. The manager of the packaging department came to your office very angry. She said that expedited orders are causing her budget overruns because of labor overtime. She said the packaging department would no longer be able to guarantee an expedited sales order. She also suggested that it was unethical for you to meet your budget goals by causing the packaging department to be unable to meet its budget goals. Okay, so we're talking here about various areas. Okay, so this particular online sales division would be a profit center, but the packaging department may not be. They may be responsible only for the costs. And so maybe that's something we could explain or something we could work in and maybe add them in together. And so incentives and responsibility are really important to adequately line those. So let's talk about the responsibility accounting system. So these are the systems that are used to support and measure the performance of each division. So a responsibility accounting system holds individual managers responsible for the performance of the business center, be it a cost center, be it a revenue center, be it an investment center. In addition, such systems provide top management with information useful in identifying strengths and weaknesses among the units throughout the organization. So they're going to be managing up top, and they're going to use this information to not only track the responsibility, but identify strengths and weaknesses of each program. And it's these reports out of this responsibility management system that's going to allow us to do that. So let's take a look at a responsibility income statement. Now this has got to be pretty small on your screen, but here's the various divisions. So here's the entire company's financial statements here, and there's some that are common fixed costs. Okay, so those are going to be part of the entire company. But the two investment centers, being the retail division and the mail order division, are responsible for their sales, their costs, their fixed costs across their division. Okay, so that's for investment centers. Okay, so let's look specifically for the retail division. We're going to see that retail division is going to be broken down a little bit more into its two stores, the 42nd Street store and the Baker Street store. So we can see those two divisions there, and those are profit centers. Okay, and those profit centers are also going to be responsible for their portion of the traceable fixed cost, but not for the common costs among the whole division. So what is their responsibility margin? Okay, so that is what they're in charge of. All right, now further, this 42nd Street store breaks itself up into two more profit centers, which are the sales department and the repairs department, and they're going to be evaluated on their responsibility margin, where we take out the common fixed costs for the 42nd Street store. Okay, so we can see how that looks here. So now we're going to try to describe this a little bit further, how this would work. So first, assigning the revenues and costs. Okay, so first, costs are classified into variable costs and fixed costs. Okay, And when these costs are classified, a subtotal may be developed to show the contribution margin of the business center. So here's our contribution margin for that center. And then we want to allocate those costs that are directly traceable to the center. So the variable costs are already directly traceable. But the fixed costs, we want to know which fixed costs are directly traceable to that center. Okay, and which ones belong to maybe a higher level or are common costs across both divisions. Okay, so what are the variable costs? Okay, these are the ones that vary in proportion to the sales volume. Those would be assigned. That would then allow us to take the revenues less the variable costs to calculate the contribution margin applicable to that segment. The fixed cost would then be traceable to that particular business center. So the ones that are traceable, that is, could they be eliminated if the center were closed? The common fixed costs jointly benefit several parts of the business, and that would not change. So we want to be really careful in allocating the ones that are manageable to the particular segment, and the ones that are part of or benefit commonly several parts of the business, we want to keep track of that separately. So let's see the fixed cost in the monthly reports here. So here are our retail division. Here is the two profit centers. That would be the 42nd Street store and the Baker Street store. We recognize that part of that would be traceable to departments. And so here are the common fixed costs, and here are the portions that are applicable to the 42nd Street store. And so this breaks down the retail division and goes further to the 42nd Street store. We see the 60,000, 32,000 of which is traceable to the departments. 28,000 is common to the sales department and the repairs department. So we can see what that looks like here. Okay, so now let's calculate the responsibility margin. And so we see we have the entire company, we have the retail sales division and the online sales division, and we see what those look like here. And we can see what the margin is for each of these, and then we rate those managers based on their responsibility margin. You can see we've taken out common fixed costs, doesn't include income tax expense because that's not something the manager or the division head of the retail center sales can division or the online sales division can manage. So as we look through this, we can see a little bit further what the responsibility income statement would look like for the 42nd Street store. Okay, and so that would show up there. All right, some fixed costs are traceable to a center are simply beyond the manager's immediate control. If a center is saddled with high costs that the manager can't control, then it's outside of it. There's nothing they can do about it, and manager's not going to be happy about it if that's something they can't control. All right, so let's go a little bit further here. What are the traceable fixed costs? And so there are traceable fixed costs are controllable, either controllable or committed. So controllable means the manager's immediate control, such as salaries and advertising. They can decide, yes, we're doing that, no, we are not. All right, the committed fixed costs are those the manager cannot readily change, but might be able to change over the future, and that would be things like depreciation and property taxes. So in the responsibility income statement, controllable fixed costs, these costs can be deducted. The committed fixed costs can then be deducted from the performance margin to determine responsibility margin. Okay. So the key point here is that some are controllable immediately and some we can't readily change, and so we may want to track those differently. There are some arguments against allocating these common fixed costs. The common fixed costs often would not change even if a center were eliminated. Common fixed costs are not under the direct control, and we want to just use those or evaluate those that are just under the direct control. And we want to allocate those common fixed costs because they are unrelated to the center's performance. Okay, so let's go on to the next topic, and that is transfer prices. Transfer prices are transferred from one department to another. Transfer prices play an important part in the evaluation of a departmental performance. Okay, so let's see what this looks like. Okay, so let's take a careful look at this. Customer gets the product, and that's revenue to NewTek overall. But let's say this comes from the online sales division and it is shipped out. And the online division gets the product from the retail sales division. So when items are sold or transferred from retail sales division to the online sales division, well, the online sales division records that as a cost, whereas the retail division records that as a revenue. There are several ways that we need to think about how those costs transfer. Is it the market price? Is it the negotiated price? Or is it a cost plus price? Because depending on what we choose to be the transfer price will affect the responsibility margins for each of the different divisions. All right, so let's talk about transfer prices for profit centers. Profit centers normally sell their output organizations outside, but sometimes they sell a portion of their output to other business units within the same company, same business organization. Many companies now use market value as the transfer price of products produced in profit centers. In this way, the department profit winds up in the profit center that originated the product rather than the center to which the product is transferred. So if we could do it at market price, that may well make sense, and the appropriate profit goes to the appropriate division. Okay, but there are some cases when transfer prices at market price don't exist. Okay, so this is a very specialized product. So there's not a well-defined market, and when market prices do not exist, companies have to use other types of transfer prices, such as a negotiated transfer price, or soon we'll talk about a cost plus price. So one would be, okay, get in the room and we're going to negotiate and see what's fair, reasonably fair to both parties. The other way to look at it is cost plus transfer pricing. So we say, okay, the supplying division, hey, they have certain costs, and then we're going to mark it up by a certain percentage to allow a small profit. Some companies may want responsibility managers to transfer products internally, but they may not want to use negotiation. They simply say, tell us the cost, and then we'll mark it up by 15 or 20%. And that way, some of the profits will be automatically allocated to the supplying division. Okay, so it's not just all at cost. All right, so let's see how this might come out. Okay, so we try to use market price whenever we can, but sometimes it's not possible to use that market price. And so we're going to use either negotiated or we're going to use a cost plus transfer price. Okay, so let's say Division A sells product to Division B, and the negotiated price is $53. And so we can see the impact there on the division. Here the return on sales is 20.75, and here it is 12.67 because the costs are higher. What would happen if the transfer price going from Division A to Division B were cost plus or a little bit lower? Well, this lowers the perceived profitability of Division A and increases it for Division B. So you can see it has an impact there, and a fairly dramatic impact. And so that's why this is kind of negotiable. If we're going to rate performance of Division A based on profits and Division B based on profits, then they want to find something that is reasonably fair to both. And it could be negotiated, it could be cost plus. Okay, transfer prices for multinational companies. Okay, so setting appropriate transfer prices becomes more complicated if a business is located in a different country. That's because different countries have different taxes. The more profits you make in a low tax or low tariff organization will be better off for the company. In addition, the market value of the goods may be quite different in one country, in the country where they're manufactured versus the country where they are shipped. And so there are intercompany transfer prices, and this essentially eliminates the countrywide financial statements are eliminated, so they offset each other. And so those don't affect the overall company, but they do affect the valuation of each individual company because they have different rates. Okay, so let's use an example here. Microsoft. All right, so let's look. They have done some income shifting. They've been moving profits from one area to another. So they put in their financial statements, hey, there are some various income tax measures. There's some unrecognized tax benefits because of some transfer pricing issues between the U.S. parent country and certain of its foreign tax affiliates. Sometimes it is a practice of these companies to try to show more income in low tax countries. And so the U.S. tax court must have had a difference with this, and so they're going to be evaluating, the IRS and the company are going to be evaluating this and perhaps go to court based on this. All right, so let's proceed here. Transfer prices are only entries made in the accounting records to record the flow of goods and services. Okay, the transfer price may be viewed as revenue earned by one and costs to the other. Okay, that we recognize that. As these department revenue and cost amounts are equal, they don't affect the overall company profits, but they do affect the company's, or at least pre-tax, right? Because they might affect the taxes paid in certain countries or another, but the pre-tax operating income is not changed, but it would change your evaluation of the various segments. There are also some non-financial measures we want to use to evaluate our responsibility center performance. Okay, so it's not just all profits, costs, and investments. It could be a lot of other items that you might consider in something akin to the balanced scorecard, where we're measuring a lot of these performance measures, and these are longer term, the health of the company, and they might also be used to evaluate these. Okay, so responsibility center reporting in financial statements. A large corporation may have literally thousands of centers. The cost, the profit centers. The Financial Accounting Standards Board says, please disclose the segment information along major segments. And so there's going to be some segment information provided along the biggest segments so we can track how well each division is doing.